Back tonight on In Focus, the South African Reserve Bank's Monetary Policy Committee has decided to hike interest rates by 50 basis points. This means the repo rate, which is how much the SARB charges commercial banks to borrow money, has risen to 4.75%. The prime lending rate, which is what banks charge customers to borrow, has climbed up to 8.25%. Reserve Bank Governor Lesija Kganyago says the increase is due to rocketing food and fuel prices.
In the near term, headline inflation has increased well above the midpoint of the inflation target band and is forecast to breach the target range in the second quarter. Headline inflation then returns closer to the midpoint in the fourth quarter of 2024, taking into account the policy rate trajectory indicated by the bank's quarterly projection model. Against this backdrop, the MPC decided to increase the repurchase rate by 50 basis points to 4.75% per annum with effect from the 20th of May 2022.
Joining us now to explain how this will impact consumers and those currently servicing debt is Benay Sager, Chief Operations Officer at DebtBusters, and economist Dr. Elna Moolman from Standard Bank. Good evening to you, and thank you very much for your time and joining us tonight up here on In Focus. Dr. Elna, let's start with you. Is this an essential act, and why so?
Good evening. I think it's a difficult question to answer whether it's essential. Do we know that interest rates will rise over the next year or two? Absolutely. Is it essential that they rise over the next year or two? Absolutely. Where the judgment comes in is in the pace of the rate hikes. In other words, it's always going to be a judgment call and quite subjective on whether we accelerate the rate hikes a little bit or whether we do it a little bit more gradually. And what the Reserve Bank has decided today to do is to rather be a little bit preemptive. And so the idea is you give quite a lot of medicine up front, and you hope that that means that you ultimately have to do a little bit less. What the governor is strongly arguing is the longer you delay this and the more you allow inflation to spiral, the higher the probability that ultimately you may have to do a little bit more. So to come back to your original question, rate hikes are essential, are inevitable, but the pace of the rate hikes are to a large extent a judgment call.
I'll come back to that in a moment. Benay, good news for those with fixed rate credit, but not so good news for those with varying rate credit. Why?
Yeah, I think, often what you would find is in South Africa, most of the bond and vehicle finance agreements are linked to the repo rate. So anytime there's a movement up or down, consumers get impacted, and we see this almost immediately. And it's a significant hike for most consumers, particularly for those who have, for the first time, were brave enough in the last 2 years to start purchasing an asset. And, they got in at when the interest rates were much lower. Now they're going to, unfortunately, feel being squeezed. This is on top of course, inflation. But, I think it's as the doctor said, it's how long interest rates will rise and by how much. It is a judgment call. What we do know is the impact of this, along with inflation, is going to squeeze the consumers, and we can already see it. Yeah. And I think where it's probably not going to hurt the consumers as much is when they have unsecured borrowings. But, those generally come in a much higher interest rate anyway. You're looking at somewhere between 18 to 22%. So, those are already at high levels. So I think we're going to see everything, from an interest rate perspective go up, even with those that are fixed, that generally tend to be quite high. So I think it's going to have a major impact on consumers.
So we saw a report released by First National Bank, I think this past week, saying that most middle-income earners spend at least 80% of their salary, at least in the first 5 days. How much of that goes to debt? How much are we spending our salaries servicing debt?
Yeah, so we, as DebtBusters, publish something called the Debt Index every 3 months. And this is when we look at consumers who apply to debt counseling with us. And that's our business of course, we're looking at a subsection of consumers. It's not the entire base. But what's striking for me this time around was you referred to the FNB report, how similar our ratios are in terms of looking. We said in our most recent report that consumers are spending about 62% of their take-home pay to service their debt. This is a median, not an average. And it was almost identical to the numbers that FNB published. I believe it was combined 65% for those who have an asset and who have unsecured lending. And, you know, we generally look at a very thin sliver of the population. And, you know, for us, it's always been around that time. So I think what you heard is also we can confirm what we see with our consumers, you know, out in the open marketplace. So unfortunately, it looks like we're probably spending about 2/3 of our take-home pay to service debt for those of us who have it.
So Elna, let's talk back to what you were raising then earlier on. I mean, we know that according to the Reserve Bank, we are still more or less on that favorable side of hiking up interest rates because we have not nearly hit the pre-COVID number. So we will be looking at rising interest rates up to about 6% before we start talking about limiting economic growth. So is it a good thing for them to be ahead of the curve? And they're saying more than likely another 50 basis point before maybe we look at 25 basis point next hike.
Yes, absolutely. So I think there are a number of reasons why it's always going to be preferred to rather be a little bit preemptive. One reason would be precisely the debt that consumers tend to accumulate when interest rates are low. In other words, if we cut interest rates very aggressively to very low levels like we did in 2020, just to keep the economy going in a severe crisis, then it means that ultimately consumers are going to take advantage of it and they get used to the lower interest rates and therefore they start borrowing. But they are borrowing at these lower costs. And so if then ultimately rates start to rise, it means that many of them become under pressure. And so from a Reserve Bank perspective, the more gradual you can increase the pressure, the better. The more people have time to get used to the higher levels, the more there's scope for some wage growth along the way or adjusting your income or spending patterns. So it's always preferable to have it more gradually. Then the other point that the governor in particular stressed today is that if you wait too long and inflation gets out of hand, it typically tends to become a spiral. In other words, prices increase, therefore we want higher wages. If wages increase, it means that costs generally go up and therefore we have more inflation. And so it becomes a spiral. And if you then want to contain it, then you have to be more aggressive, hiking quite quickly. And then you have the problem that so many people, and I refer to consumers here, but the same would apply to smaller businesses as well, then you find that people very quickly become in trouble. So it's always preferable to rather be preemptive and try to smooth the increase in pressure as much as you can.
Yeah. So I don't know if we are able to actually answer this question, but Moody's predicting in their report that South Africa's inflation could possibly hit 8% by the end of this year. So hiking them up so quickly and at the rate that we are hiking them up, will that help at least to keep us in that mid-range where we like to sit?
It would definitely help. I disagree with Moody's. I think they're extrapolating too much what's happening elsewhere, particularly in the developed countries, where the situation is very different. Very strong economies, very strong labor markets, very high wage inflation, and so there you have a real inflation problem. I disagree with Moody's that we'll reach 8%. We think that at the highest, South Africa's inflation rate would get to about 7%, and it would really very briefly get there. And that increase is to a large extent still food and fuel prices. So what the Reserve Bank is trying to do is to say, we can't do much about the food and fuel prices. But if we just trim economic growth and contain it a little bit and just ensure that we don't have enough growth to start a wage inflation spiral, then we can be sure or reasonably comfortable that we'll have this inflation spike that we can do little about, but that it will then come down again. Yeah. What you absolutely want to avoid at all costs is any kind of spiral, so that we go to 7% because of food and fuel, and then it becomes the increase in wages and general costs, etc., because that becomes very difficult to fight.
Benay, what happens to the borrowing power of small businesses when this happens?
I mean, I think businesses are already feeling like they're going to be reeling. I mean, depends on at what rates they borrowed. But I can speak on behalf of the consumers, which is what we see, and it plays out in the microcosm. It's going to make it difficult for many consumers to borrow afresh. And for those who do have bonds and vehicle finance agreements in particular, they're going to have tough times. Remember, 2 years ago, there were also what we call bank payment holidays that really helped consumers. And a lot of them actually coming out of that in early 2021 felt the heat. But then the interest rates were still low. And I think now we're actually going to see the hike. So unfortunately, I think even for businesses, there may be more appetite to lend from the bank's perspective because the interest rates are higher. But I think that they will be probably more selective in terms of who they're lending to. And I think a lot of businesses might find it difficult, just as consumers, in terms of the borrowing prospects, depending on their financial situation.
Interesting, though, that you raise that particular matter. Let's talk about what consumers then generally tend to cut, because, as you put it, they don't go for the luxuries now. They turn their focus to essentials. What are the things that they tend to cut the most when interest rates are hiked?
Yeah, actually, we have been saying this for a number of years. South African consumer isn't necessarily spending a lot of money on luxuries. In fact, what's happened over the last 5-6 years is salaries have been predominantly flat. And I mean, I think a lot of people have already cut back a lot. But what really happened in the last 2 years, 2.5 years, is most consumers have been stretched. They used to support their kids and their parents. Now they're supporting kids, parents, uncles, aunts, friends because of the pandemic. They've been really stretched up, down, and sideways. And really, you know, when we talk to consumers, when they are seeking for solutions, we rarely find money being spent on luxuries, which is very different to the situation, let's say, in 2013, 2014. And I think even something as regular as, let's say, having a DSTV is kind of seen as a luxury these days by consumers, and most of them have been cutting back and looking for cheaper alternatives. Cell phone contracts, insurance. Consumers have been shopping around quite a bit. I think a lot more than we would like to probably realize. So I think, we need to probably recognize that South African consumer has been very savvy in terms of spending habits over the last few years, but I think they're really feeling squeezed because of the debt burden, predominantly with the interest rates and the inflation that we talked about.
Dr. Elna, as we wrap up, quick 30 seconds, the Reserve Bank governor says it's power, electricity, that's part of the problem, load shedding. The other one, of course, is climate change, flooding in KwaZulu-Natal. We can't really do anything about those. But the third thing is policy constraints, which have really led us to the type of situation that we're dealing with. So what does government need to do here?
Absolutely. Just remove these growth bottlenecks. In other words, for the next, like you've mentioned, over the next year or maybe even 2 years, we'll have this load shedding, and there's increasing concerns from a business perspective about logistical constraints as well. But if we start addressing this now, and of course on electricity, we have been working on this for quite a number of years, then it means that 18 months from now, the situation can be quite different. So where we have seen the government interventions accumulating some traction is in the electricity, the transportation, and then, of course, the communication areas with the spectrum auction that we recently concluded. So those things should at least mean that we're on our way towards a slightly better growth situation.
Appreciate you both for coming on tonight. That is Benay Sager, Chief Operation Officer for DebtBusters, and economist Dr. Elna Moolman for Standard Bank.